Let's meet Bill Ackman, one of the top-notch investors out there, and for an incredible reason too. He has gained an average return of 16.9% per year since 2004. If you look at the S&P's average return with the same given time frame, Ackman's is way higher. During the 2008 recession, his skills and expertise fueled his portfolio with billions of dollars. And if that's not impressive enough, he also turned an initial $27 million to $2.6 billion in the middle of the pandemic-stricken economy. You could see how this legend made use of the last two crashes and earned billions. Now, he is ready once again to put his bet on something he believes would be another giant cash cow for him. Well, he isn't actually a very likable person to some, to say the least, but his record tells us that it wouldn't hurt to actually get a thing or two from him. That's exactly what we're gonna sum up for you. What is Ackman seeing in the possible future, and what can we learn to follow into his billionaire footsteps? Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. First of all, Bill has two major strategies that he uses as a recipe for his annual high returns. Number one is himself, or rather, himself that he uses his influential powers to somehow impact several business operations, specifically the ones he has invested in. This is also called activist investing. The second one is a bit more profitable, which is short-term speculation. And this second method is what we will break down in today's video. You see, Bill Ackman is very wise when it comes to betting on short-term movements, as he always looks out for asymmetric risk. Essentially, investors would like to think that the higher risk you take, the higher reward you get. But people like Ackman don't think so. Hedge fund managers such as him tend to look for asymmetric risks, which is low risk and high reward. Recently, Ackman found bets with this kind of asymmetric ratio. It's no secret that we only currently have inflation slowly growing and accelerating despite previous inflation rates being only brief. If we look at the numbers, the annual growth rate in consumer prices has jumped from 1.2% in November 2020 to 6.8% in November 2021. This is obviously an overwhelming leap in just a year. Here's how. The Fed has been a bit stubborn when it comes to the printing flow of trillions of dollars, all with these 0% interest rates. The Fed's actions have come along with the price as this has increased the stock market significantly, but this is not long-term. Back in October 2021, Bill Ackman presented to the Federal Reserve about how they should be taking a step back. He showed the inevitability of a big market crash that is about to happen given a few contributing variables. First, the government has projected $5.1 trillion of stimulus into the economy when the pandemic began. This $5.1 trillion is actually 25% of the GDP, which is unprecedented in its consequences. Currently, the feds are constantly purchasing bonds worth up to billions of dollars. This is continuing to save the US economy. However, for now, and what this is doing is causing more future economic problems to pile up instead of actually finding a complete solution. Fed's chair, Jerome Powell, is responding to inflation, calling it something frustrating to look into the future. The stock market crashing doesn't necessarily happen out of the blue. There are always factors or even that subsequently lead up to catalyze a market crash. The Fed's actions have left two options, both with not so pretty outcomes too. First is raising the interest to stop quantitative easing for the economy's sake. When this happens, it's almost certain that a market crash is going to happen. But at the same time, this will save the US dollar from impending inflation. The second option the feds have to use is to pull back and let zero interest rates continue, letting inflation accelerate. In other words, keep printing and printing and printing. But the outcome would be generally heavier considering it would lead to a crash as well as destroying the value of the US dollar. Bill Ackman is trying to push the feds to go with the first option, which is to back down and begin raising rates. Again, both could lead to a crash either way, but we guess it's better to go for the lesser impact when it happens. Ackman further explained it, saying, "We are continuing to dance while the music is playing and it is time to turn down the music and let it settle down." A reference to the 2011 film Margin Call that tells a story about a hypothetical market crash about to happen. The economy has been doing pretty well, while Bill Ackman continues to dance and the feds are keeping rates at 0%. However, the feds can be better and shut off the music to give the economy a heavy yet plausible solution. To keep up with this strategy, Ackman is initiating position to hedge his portfolio. He stated, as we previously disclosed, we have to put our money where our mouth is in hedging our exposure to an upward move in rates, as we believe that this rise in rates could negatively impact our long-only equity portfolio. There are actually a few number of markets where investors can short their portfolio, but Ackman has his bets on one particular market, the bond market. The bond market has shown a significant rise during the last 10 years or so. This enabled bond yields to go to all-time lows. Some of you may be aware that an increase in bond prices corresponds to a decrease in bond yields, and of course, vice versa, when the bond prices decrease as the bond yields increase. They are inversely related. Thus, shorting the bond market is a bet on bond yields rising. Currently, the 10-year U.S. Treasury bond yields stand at 1.4%, a number that is exceedingly lower than the inflation rate. So, we are to ask why in the world would we purchase bonds when the inflation would be way higher than 1% anyway? Investing in this asset is certainly like throwing your money into the pits. Ray Dalio, Cathie Wood, and Warren Buffett all believe that bonds are not in good shape as of the moment, and we know they're only the ones who think that. Shorting the bond market is still an uneven bet because bond yields can't go any lower. Although bond yields can easily increase greatly to account for the big rise in the inflation rate, this is the short trade that Michael Burry is actually doing. He has implied that he is joining in the bond market by directly short selling his bond DTF such as TLT or the iShares 20-plus year bond treasury ETF. However, for investors such as Burry with a high net worth, they may be using a more complex strategy on bonds that is not exactly accessible for retail investors. We know Bill Ackman is certainly doing so. He is purchasing two different derivatives, credit default swaps and put swaptions. These are option contracts to swap bonds. With that comes two different interest rates as well. First is the floating interest rate that change based on the bond market and a fixed interest rate that stays just the same in any circumstance. Swap options are derivatives that are purchased from the perspective of the bond lender. Instead of obtaining an interest rate for purchasing a bond, the owners have to pay bondholders instead. Meanwhile, a put swaption is a contract to beat the bond lender while paying a fixed rate to the bondholder. Once the interest rates increase at a certain point, the owner of the puts option would be profiting off the difference of the interest rates. When this happens, the floating interest rates would be increased by 4%, but the owner of the put swaption has a contract to pay a fixed rate of 2%. This makes the put swaption owner profit from the difference in interest rates, which is 2%. This difference would increase the put swaption's value, also letting the owner make tons of money from it even with a small capital. Ackman was purchasing swaptions so that when the interest rates increase, he'd still continue to profit well from it. But if the interest rates decrease or stay the same, it doesn't really create an impact on him. The other derivative he was buying was credit default swaps. This is somehow like buying insurance for a house. The owner starts off by paying a small amount periodically. To put in perspective, let's say $500 per month. This derivative is insurance for the borrower's ability to pay monthly in an event where the bond defaults. The banks would have to start paying the bond with monthly payments as well. And this payment would be a lot higher than the $500. To further explain, let's say that amount is $10,000 per month. And hypothetically speaking, we can create an analogy of a house catching on fire on insurance, because the bank now has to pay an amount as large as $500,000 for repairs for a house costing $500 per month. So, put swaptions and credit default swaps are the two main strategies that Bill Ackman is using to be able to profit billions even in the middle of a crash. He already did it successfully in the 2008 recession, throughout the pandemic, and now he is throwing his money on swaptions once more. Ackman was able to purchase credit default swaps with bond insurers in Fannie Mae and Freddie Mac. This resulted in the S&P going down by 52%. On the other hand, Ackman explained how they were able to finish the year down only a few percent and was able to rise back up to 40% by the following year. So he was driven that by hedging gain as well as redeployment of those procedures and buying stocks. When the pandemic hit the second quarter of 2020, he did the same process. He believed that the best way to address this concern with minimal risk is to buy credit defaults. Along with this, he had very large notion in the credit default swap market. Once their portfolios declined in value, they reversed the position to make their stocks go down, but with their hedge extremely valuable. This gave them potential capital to be invested, amounting to almost $2 billion in a market that was down. He further shares his recent fears in the market with inflation. Initially, he believed inflation would cause higher rates, leading to lower values in equity markets. They built once again a large position with bets that rates would be increasing more on swaptions. Anyway, these capital commitments are 1% or even 0.5%, but numbers like these are not impossible to increase and grow into very large rates when an outlier event occurs. So we recently mentioned how the annual growth for consumer prices, which is 1.2%, grew exponentially to 6.8%, but it's not necessarily factual. The rate that we're talking about is tied to Consumer Price Index, or CPI. The CPI tracks a basket of goods that are weighted and turned into an average for each consumer good. This sounds reliable, but the housing percentages are not so valid in the price index. For Ackman, an owner's equivalent rent, or OER, is understanding inflation based on surveys, using a more suitable and reliable rent tracker. Ackman found that instead of 6.8%, the annual inflation growth rate should be actually 10.1%. He further explains in a tweet, and we quote, "Reported inflation is understated. Owners' equivalent rent, OER, relies on owner surveys to estimate inflation in housing costs. This is an extremely imprecise metric. This single-family rental market provides more accurate data." Or, in today's reported core CPI was 3.5% YOY. We agree that this is unusual for the OER to be reporting rent prices as low as 3.5%, so this sounds pretty inaccurate. Ackman further tweeted how the largest owners of a single-family rental are experiencing 17% increase by the year, 30% of the core CPI calculation, and 24% the reported CPI is in fact the OER. He further added, using the more empirical measure in the calculation increases today's core CPI from 4.9% to 9.0%, and the CPI from 6.8% to 10.1%. With a 10.1% inflation rate, it would cause the bond market to be concerned. Now, investors' net inflation with adjusted returns will be at 8.7% per year. Some might think that inflation like this is merely transitory, but not Ackman. He says again in a tweet, housing inflation is unlikely to abate based on supply and demand trends. The inflation the households are experiencing is raging and well in excess of reported government statistics. And as if the situation couldn't get any worse, the fiscal policies from Congress are not much of help. Joe Biden is planning to pass an infrastructure bill under the Build Back Better bill that may or may not amount to $2 or $3 trillion. This is actually 10 to 15% of the US's entire GDP. In conclusion, this might let inflation continue to drastically push forward. Bill Ackman also cited a few other concerns, which includes the weakening of China's growth, future emergence of new COVID variants, second-order impacts from supply chain constraints, and geopolitical and cybersecurity risks. These factors can pull back the financial markets from moving forward. We could just wait and see. There we go. Bill Ackman's take on one of the biggest market crashes in history. We might not think he is 100% right, but considering his status and credibility, he might know a thing or two. Better be safe than sorry. Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.